All right, let's jump into this. So, one of the ideas that I want to share with everyone before we jump into our foundations class for tonight is this idea of creating the perfect life, which we would say is an idea that is when you have abundance or excellence in all areas of life, that's when we'd say you're living the ideal life. So, you got a strong spiritual purpose. You're winning in the personal area of life. That could be mental, it could be physical. You got your family life dialed in. The relationships there are healthy and abundant. You love what you do for an occupation. And tonight we're going to spend a little bit of time talking about the financial area of life. And the only reason that we would get excited about teaching someone how to win financially is so you can go out and fund your life's missions in other areas of life. And so the purpose of winning financially is just that, to fund the other missions in your life. So let's talk real quick about this, something we call the tough money effect here at Factum. Now, the reality is your ability to thrive financially over time, not if, but when events happen in your life, will be dictated by how tough is your money. So events could take many, many different forms. It could be a lawsuit, it could be a recession, it could be an accident, a death, a divorce. Events can take many, many different forms. And if we don't have certain things dialed in our financial plan, usually when these events happen, we always feel like there's a setback. We go backwards financially. And we're going to talk about a few ideas tonight on how to make sure that we're always in a position to, number one, stay where we're at financially, but then hopefully use some of those events as really big wealth building opportunities. I'm going to share some personal stories a little bit later on tonight's call. So, how do you know if you have tough money? Well, we're going to take everyone through tonight the tough money experience, and we're going to cover three main ideas. So, idea number one is what we call the inconvenient truth. And the question that we should all be asking ourselves is, how do my habits affect my wealth plan? Um, our habits drastically affect our wealth plan, and I think it is the inconvenient truth that no one is coming to save us. It's up to us to do certain things with our money that no one else is going to be able to come in and do for us. And idea number two is what we call the problem. And this is a problem that once you see this problem, you'll never be able to look at money the same way again. And a question that we should be able to answer after this segment is, how does the world of banking affect my wealth plan? And then idea number three that we're going to end with tonight is an idea we call the toughest asset. And everything we do here at Factum is centered around making you tougher with your money. And so, in order to have tough money, we need to understand what is the foundation of my wealth plan, because you can argue that the foundation of anything needs to be the toughest area of your financial life. And so, with that, let's jump right into this. And let's get acquainted real quick with something, a framework that we call the path of money. Now, money can seem like a pretty complex subject until you have the right frameworks and systems to be operating in. And there's really only four things we can do with money as it's flowing into our life. So everyone on the call probably has an active income, meaning we're going to work for money. We trade time for money. And some of us on the call might be building passive income through some type of investment strategy. And as that money is flowing into our life, there's only four things we can do with it. We can spend it, we can donate it. The rest is called savings. And so the third thing you can do with money is hold it. And if you can do those first three things efficiently, spend enough, donate enough, hold enough, then you get to do, I think, what a lot of people want to do. They would say the exciting thing is the investing piece. But if you don't understand this path of money, it's always going to feel like something is off in your financial life. So the fourth thing that we can do is invest it. And hopefully we're investing into assets that produce income that allow us to fund and live the ideal life. So we're going to be talking a lot about this third thing we can do tonight, which is hold it. I think how much money we save and where it's saved can make a remarkably big difference in our wealth plan. Now, when we're looking at this path of money, there's also clues on this. And we're going to give everyone on the call tonight a chance to book a path of money analysis with a wealth building team member of ours. And if you know things like your income, your liquid net worth, your investment equity, which make up your total net worth. If you know just a few of these key numbers, these are actually all really, really big clues as to what we need to be focusing on next in the wealth game to keep progressing. I think we can all agree that there are certain steps that everyone wants to be taking, but sometimes it feels a little bit uncertain. So the first conversation idea we're going to talk about tonight is going to that inconvenient truth. How do my habits affect my wealth plan? So, if we can all agree on a couple things, one of those things needs to be there are levels to the wealth game. I think sometimes when you hear someone speak from a stage or they have a very, very high net worth or they feel like they're just out of our league, sometimes we hear what they're doing and we want to get enticed by, oh, I want to go do that stuff too. But depending on what wealth level you're in should actually give you all the clues of what you should be focusing on next. So we might have someone on the call tonight worth 15 million or more dollars. We might have someone on the call that has a net worth of $50,000. And the way that we would think about this is we need to understand what is my wealth level and then what are the next best steps. So we would classify anything between zero net worth and $100,000 of net worth as level one. Anything from 100,000 to a million is level two. Anything from 1 million to 10 million would be level three. And anything past 10 million, we're going to call level four. Now, the further you go up this wealth framework, the less people you're going to find there. And so, as we are navigating this, if you know a few key indicators, which is why booking a path of money analysis with one of our team members is going to be so helpful to you, is because if you can identify, okay, what is my current net worth? In this case, we're going to be looking at this family that has a current net worth of $840,000. And they've said, Kyle, our target net worth or our goal of where we want to go in the future is 3 million bucks. And maybe we have $50,000 of liquidity or cash reserves. And all of these will be clues as to what you should be doing next. So our job here at Factum is to help you go from point A, where you're currently at, to point B, where you want to go in less time with less risk. And so everyone on the call might resonate with this image right here. So if you are at a current net worth of $840,000 and you want to go to a $3 million net worth, it probably feels like this. What do I even focus on? Do I need to start looking into tax strategies? I hear people have wills and trusts set up. Do I need to get my auto insurance dialed in? Do I need a financial management company? Should I buy whole life insurance, start the infinite banking concept? It can feel very overwhelming. Like I don't even know what to start. So I'm just going to reach into this junk drawer, if you will, and pull something out and hope it works. And what we've done here at Factum with some of our frameworks and systems is we've organized all of these things that you will need, whether you have a net worth of $50,000 or $15 million. There are certain things you want to be focused on at every one of these levels. And so with this individual who has a current net worth of 840,000, if they're in level two, there's certain things they really want to focus on that's going to allow them to get through level two quite quickly with less time and less risk to get into the level three strategies. Now, if we can all agree that we are blessed to live in the United States, I think this is a wonderful call to be on. And I would imagine all of us can agree we're very blessed with opportunity to live in this country. And I'm going to go through these a little bit quickly. If you have not seen some of this online, you'll get the point here. But for a U.S. household that brings in $50,000 a year, you got to be bringing in, you got to be bringing in about $50,000 a year to be in the top 50% of income earners. Now, if you bring in just under 100,000, you're in the top 25% of Americans. If you make 170, 178 in that range, you're in the top 10% of income earners. 261 would put you in top 5%, and the top 1% of income earners in the U.S. are bringing in $660,000. Now, the reason I'm sharing this is we get the chance to speak all over the country to thousands and thousands of Americans every year. And one of the things that I hear most often is, Kyle, if I could just make more money, That would solve all of my financial pressure. And the inconvenient truth is, I don't think that income is necessarily our problem in this country. Because if you look at the worldwide stat, what do you need to be bringing in to be in the top 1% of income earners worldwide? It's $34,000. And so even if you're making $50,000 in the United States, you have a substantially higher income than the rest of the world. So my takeaway from this is income is not our problem. So let's identify what is the problem. With as much money as we make in this country, our problem is how much of that are we actually keeping? The personal savings rate as of April this year was 2.6%, meaning Americans are keeping considerably less than 5% of their income is what's actually staying in some type of bank account or on your balance sheet, if you will. And this is a tremendous problem. And, one of the things that I hope we can all agree on is making money and keeping money are very different skill sets. Some of us can have gotten pretty good at making the money, but maybe you were a bit like me growing up, but I never really had anything taught to me in school. I had to start finding books that were teaching me and giving me a system and a framework to work through on how to save more and keep more of the money I was making. So this is going to be a clue for a little bit later in the call. But if you want to start winning financially, the inconvenient truth is you've got to save more money. You've got to get into this 10 to 30% range. If you're going to save 5% or less of your income, there's no easy way to say it, but you'll never be wealthy. You can't do any cool things like you won't be able to invest. If you're looking into the infinite banking concept, you won't be able to have the financial disciplines to fund a policy as your private banking source. And so this is the inconvenient truth. We've got to save more money as a culture. Now, we've all heard this too. Cash is king. We hear that all the time. And I think it's true, but I don't think a lot of Americans are abiding by this. So I'm out here in the Phoenix area. I know we have a few people tuned in from all over Chicago, Virginia. This is a study that the JP Morgan Chase Institute did looking at 600,000 small business owners. And what we find is in the Phoenix area, the average days of liquidity or cash reserves is less than 30 days. So if a business owner in Phoenix goes 30 days without income, they're feeling serious financial pressure. And this is why if you ask most Americans, do you ever feel financial pressure? They'll tell you like every single day of my life. It's not because we don't have enough money coming into our lives. It's because it's how much of that are we actually keeping? And I think a couple of things that we're going to talk about in ideas 2 and 3 today, the toughest asset and the banking problem, will help us understand kind of why some of these behaviors are the way they are. So in order to fix some of these problems, we have to get a little bit closer to our money. So I'm going to read you what we call the Factum 5. These are 5 of the most important financial questions you're ever going to be asked, and this will help you build tough money. So question 1 is, do you know how much you should be earning in passive income to live the life you've always wanted? So that is a freedom number. Do you know how much money you should be earning in passive income to live the life you've always wanted? Now, you need to know exactly what that number is. So if that's $8,541 a month, that's the number that you need passively to maintain your lifestyle and do all the things you want, then you would answer yes to that question. If you're unsure about what that is, go ahead and answer no. So question 2 is, do you know how much you should be saving to achieve your passive income goal? Now, we just gave you a clue in some of the previous slides. Average Americans save 5% of their income. If you want the answer to question 2, it is between 10 and 30%. If you can't do question 2, get your savings rate up. There's no easy way to say it. You'll never be wealthy. Question 3, do you know how much you should be holding in cash reserves to guarantee your protection and opportunities when events happen? So most business owners here in Phoenix are carrying 30 days of liquidity. So if an event happens, if COVID happens, an accident, a lawsuit, a divorce, a death, if something happens, those business owners are going to be in serious financial trouble because they don't have enough cash reserves. Now, sometimes these events that happen also present really big opportunities to become wealthy. But if you don't have any cash on hand, you don't have the option to jump on any opportunities. So, question four, do you know if the current environment where you hold your money is maximizing the benefits you deserve? This one, no matter what room I go in and teach, no matter how sophisticated the investors are, this is always a huge no. I think as a general public, we know that commercial banks are the number one places most people save their money, and commercial banks are just not giving us all the benefits that I think we deserve and should be receiving. And which leads us to question five. How would you rate your current money management habits? It's okay if you're saying I don't have any, they're weak, they're average, they're strong, or can you confidently say you've got really tough money management habits? And so whatever you filled out on these questions, I know we're just doing this online, but we have tons of resources, courses, and workbooks that go along with this that'll help you understand each of these questions if you answered no to any of them. And I think one of the most important questions is right there at the bottom. Would you like to know for sure? In order to be successful as an investor, an infinite banker, if you just want to get wealthier in general, you're at a certain point financially on the call tonight, you want to get to a different financial destination in less time and less risk. It's going to be very important that you understand these questions because it's going to keep you tougher financially. So, this is going back to our path of money framework. There's only four things we can do with money. We can spend it, we can donate it, we can hold it, and we can invest it. And understanding our income, our net worth are all clues to what we should be doing next. And understanding those five questions are also a major opportunity for us to get really tough financially. And it all starts with education. Education leads to awareness, and more financial awareness leads to better money management habits. And that's what's going to allow you to be very, very successful no matter what strategy you choose as your primary wealth strategy to achieve your goals. So here's a question I'll ask to everyone on the call. There's really only 2 points here. Uh, is wealth building important or not important? Now, if wealth building is not important, you're probably not on the call tonight. But if you stumbled onto our foundations class tonight and you're kind of like, yeah, wealth building is really not that important to me, there's really no guidance required. Give yourself permission to go focus on other areas of life if this is not something that you want to actively pursue. Now, I am assuming wealth building is important, which is why you're on the call tonight. So then the question is it urgent or not? So if wealth building is important, but it's just not that urgent in your life, what you need is more education. So please reach out to whoever invited you to our class tonight. They have loads of resources, wealth scorecards, courses on money, workbooks, worksheets that'll help you understand and get better at the money game. So education's the focus. Now, if you're on the call tonight and you're like, wealth building is important to me, and it's urgent. I want to start getting this wealth stuff dialed in because I have goals that I want to hit at a certain time point in my life. Then the only thing that's going to help you accomplish that is implementation. And I'd encourage you to reach out to someone on our team and book what's called a path of money analysis. Now, let's shift gears a little bit and let's jump into idea number two now. So we talked a little bit about idea number one, which is how do my habits affect my wealth plan? If we don't have the right wealth habits, there's really no strategy that's going to work out for you long term. You've got to get tougher money habits. Let's go into idea number two, which we call the problem. How does the world of banking affect my wealth plan? I'll tell you, the first time I got exposed to this idea, it changed my paradigm around money forever, and I'll never look at money the same way again. So if you have not read this book on the screen right here, Becoming Your Own Banker by Nelson Nash, please pick it up. We have copies at our office if you want to come by and buy one in Mesa. You can find them online. They're probably 20, 25 bucks, less than 100 pages. And one of the lessons that we learn in this book from the author Nelson Nash is that you finance everything in life. And what he means by that is you either borrow money and you pay interest, or you pay cash and you give up interest you could have earned otherwise. And the problem here is that all of these items are financed by other banking organizations. So let me paint it to you this way. A lot of people think if they take $30,000 and they go purchase, let's say, a vehicle for cash, that they're saving themselves from the interest payments, right? And that's how I was taught about money. Maybe you're a bit like me growing up. Pay cash for everything, Kyle, because you don't want to make it interest payments to everyone. Well, no one ever taught me about what's called an interest cost, meaning when you use that $30,000 to pay cash for, let's say, a vehicle, you also lose what that $30,000 could have earned you over your lifetime, assuming you could have gotten, like, let's call it a 4% interest rate. So $30,000 at 4% earning rate over 30 years, it doesn't actually cost you 30 grand, it costs you $97,000. And once you get this concept in your head, I can promise you never look at money the same way again. Now, this gentleman on the right, Mr. Robert Kiyosaki, has a wonderful book called Cash Flow Quadrant. He also wrote the number one best-selling finance book of all time, Rich Dad, Poor Dad. If you have not read any of his books, I'd highly recommend it. But in his book, Cash Flow Quadrant, we learned that there's essentially four players in the money game. You can be an employee, a self-employed individual, a business owner, or an investor. And it wasn't until I met actually an orthodontist here in Chandler, Arizona, that he said, Kyle, that's great you want to get into business for yourself. It's great you want to become an investor, but you should be thinking about the role of the banker. And I wasn't really sure what he meant, but he said, Kyle, the banker influences every other player in the money game. All of these players need and rely on the banker in their life. And when you look at it this way, you'll never be able to unsee this image. Every single person on the call is one of those four players. You're an employee, you're a business owner, you're an investor, or you're a self-employed individual. And we've all been the saver, just saving money from working in our businesses or making money. We save it with a commercial bank. The bank then lends dollars out to the borrowers who are also employees, self-employed individuals, business owners, and investors. And the banks make a ton of money by controlling this flow of money. And, you know, I was always taught as the saver or the borrower, the business owner or the self-employed individual. We're always focused on creating new money. How do I sell the next thing? How do I buy some real estate and create income? All of this is creating new money. How do I get better skills to be more valuable at my job? But the banks are worried about permanently controlling money. It's a very different mindset. So most business owners, most employees are always focused on creating new money in their life. Banks are more worried about permanently controlling. That's what that PC stands for, permanently controlling money. They don't care what you do. They just want to be at the center of your financial world so more dollars will flow through their hands. And they have become some of the wealthiest companies in the world by understanding just how money is moving. So it's why you got to pick up that book, Becoming Your Own Banker, and read it. It's worth millions of dollars to you. And if we go back to our framework we've been talking about tonight, the world of banking exists right there in your path of money. Where you hold and save money that moves through your life is going to make a remarkably big impact on your wealth goals. If you are worth a certain amount tonight and you want to be worth more in the future, understanding banking and controlling that in your financial life is one of the easiest, quickest ways to start accomplishing your financial goals. Now, time for a little bit of uncomfortable questions, and I'll just let you think about this on your own. If you added up all the money you've earned in the last 10 years, so think about what that is. If you've been making $100,000 a year for the last 10 years or 50,000, whatever that is, think about all the money you've earned in the last 10 years. Maybe that's 500,000, maybe it's a million. How much of it could you access and write a check for today? And the number one answer as a percentage, and I've asked this to thousands of people across the US by this point, is less than 5%. So if we have someone on the call that's made $1 million the last 10 years, typically the largest check they could write and access today is about $50,000. That's the most common answer is 5% or less. Now, the good news is we can change that and we can reverse that and we can make it better for the future. Now, let me explain to you why the number one answer is 5%. You see, with the uncommonly high income that we make in this country, Americans are spending about 20% on automobiles, about 30% on housing, about 45% on living, and saving about 5% of their income. And so if we look at this, this is why most Americans answer is 5%, because we've gotten good at making money, but we're not so skillful at keeping money. And if you go talk to like a financial advisor, what they're going to say is, hey, great, you're saving 5% of your income. Let's take that 5%, let's put it into something for 30 years. We'll take more risk with it and we'll get you a higher rate of return. Now, when I'm looking at this, I think the greatest opportunity for most Americans to get ahead financially is actually focusing on getting more efficient with the 95% that's leaving your hands every single month, every single year, because you can actually control that. We can't necessarily control the stock market or certain investments. So let's take a look at this and let's isolate this down to something like vehicles. Um, I want to ask you this question. After all your auto purchases you've made, whether you've paid cash for your vehicles or you've financed them, think about all the automobiles you've owned and driven up until this point in your life. Are you at 5 cars, 10 cars? And the question I want to ask is how much money do you still have in your control? And everyone on the call tonight that's not implementing infinite banking, their answer is zero. We don't have anything still in our control from the vehicles that we've purchased because what we've done is we've permanently transferred money away from ourselves because we're not thinking like bankers, we're thinking like business owners, investors, and employees. And so, whether you have saved up and paid cash for vehicles or you've borrowed money from a financial institution, those both of those players in the money game arrive at the exact same destination, which is $0 towards their wealth plan. Now, it doesn't have to be this way, but it is because of the way we think. Now, remember, there's an opportunity cost to all of this. So it doesn't just cost you the price of the vehicle. It cost you what did it cost you by not controlling those dollars in your life? This is a banking problem. And these decisions compound against you and they will cost you more money over time. So we have to change that. We have to start thinking like a wealth creator, not just like a saver and a borrower. And if you'll shift your mindset, and it's going to require changing where you save money, it's going to require changing how you think about money, but you can have compound interest actually working for you every single day the rest of your life. But you're going to have to change a couple things, how you think and where you save. So the average American will drive around 13 vehicles in their lifetime. They're going to spend roughly $400,000 doing that, and they're going to end up with $0 in their control. Not because they're doing something inefficient, it's because they were never taught how the world of banking affects their wealth plan. Now, if you implement some of the ideas that we're going to talk about tonight, we will send everyone that registered for tonight and tuned in a one of our most popular videos online, which is called IBC and Vehicle Financing. We'll show you how to spend the same $400,000 and keep well over $1 million in your control, doing something you have been doing for 5, 10, 20, 30 years by now. Changing this one thing will keep way more money permanently in your control. So make sure you get with whoever invited you to the class tonight and ask them for that video, IBC and vehicle financing. It's only about 10 minutes long. We'll break down the math on how that works out. Okay, so that's going to wrap up idea number 2 for us. The problem. How does banking affect my wealth plan? The moment you understand banking and how to own that function, you are naturally going to keep way more money in your control, which is going to move you towards your wealth goals with way less risk in way less time. And let's conclude our foundations class tonight with idea number 3. Let's talk about the toughest asset. And so the question that we would ask is, what is the foundation of my wealth plan? So if you're on the call tonight, and you're like, yep, wealth building is important, it's urgent to me, we have to make sure that the foundation of your wealth plan is built properly, and it helps to have really tough assets at the foundation. So earlier in the call, we asked those Factum 5 questions, and question 4 was, do you know if the current environment where you hold your money is maximizing the benefits you deserve? Now, let's talk about where Americans are commonly saving money. And the number one answer is a commercial bank. We just let all of our money flow through a commercial bank, and they give us a few benefits here or there. Now, one of the things that we're going to talk about tonight is a whole life insurance policy, which I believe to be the toughest foundational asset that you can own. So let's talk about why that is. And let's do a quick 2 minute lesson on life insurance.
Pick up mail, please. 106.
There's two major types of life insurance. There's temporary insurance called term, and there's permanent insurance. Now, term insurance is just that. It is an insurance policy you buy that will be in force for a certain term or time period, maybe 10, 20, 30 years. And once the term expires, the insurance is gone. Now, about 1 to 2% of term insurance policies actually pay out. That doesn't mean they're bad, but you buy them for very different reasons than you would buy permanent insurance. So, I think every family should be carrying a little bit of term insurance because you can buy it for 10, 20, $30 a month sometimes. Much better than having no insurance to protect yourself against an event that you have a 100% chance of using. So I've actually just heard it this way. Term insurance is a temporary solution to a permanent problem. And I really like that. We're all going to pass away, but nobody passes away at the right time. And that's the interesting thing about life. And so a lot of people will lean towards permanent insurance. I want to buy insurance that's going to be around as long as I am. And there's really two types of permanent insurance. There's whole life and there's what's called universal life. Now, on the universal life side, you have a lot of different products and options. Index universal life, variable universal life, and these products we're not going to talk about tonight because I would classify these as more of investment grade vehicles. I would not put any of those products at the foundation of my wealth plan. The one that we're going to focus on tonight is whole life insurance. Now, over a decade ago, when I was buying my first whole life insurance policies, I had everyone, my family, my grandparents, colleagues, friends telling me, oh, dude, don't start buying whole life insurance. It's the worst thing in the world because it's got a low rate of return, it's expensive to own, it's the worst investment of all time. And that's what I was being told by just about everyone around me. Now, the interesting thing is, no one around me had ever owned this or even understood what it was. So it was just a lot of noise and talk. And one thing, if you're on the call tonight, I want you to remember that whole life insurance is not an investment. It's the biggest misconception that people have, and it keeps them from understanding what this asset is and where does it belong in your wealth plan. So, whole life insurance is not an investment. And where it exists is right in that hold category, that green box, the cash reserve. So when you're going to compare whole life insurance, there's a couple of criteria you're going to want to look at. Whole life insurance is not a product you want to own for like 3 years. So if you're looking at it like, I'm going to buy life insurance, but I'm only thinking 3 years in the future, this is not the product for you. The name itself, it's called whole life. So it's meant to be a forever asset, meaning you're going to own it for 10 years or more minimum. If you're only thinking 5 or 10 years in the future, I would say don't buy this, buy term, go invest everything else. Like that would be a better strategy. And, so when you compare life insurance, you don't want to compare it to real estate or the stock market. Those are all investments. Whole life insurance is not. And so when we look at comparing whole life insurance as a foundational asset, you want to compare it against other liquid safe accounts like high yield savings accounts, treasuries, CDs. These are all very safe, very secure, accessible places to store cash. And so when we look at like high yield savings accounts right now, you can get a decent return on those, maybe 3, 4%, but it's gross, meaning you still have to pay fees and taxes. The risk you take by owning high yield savings accounts, treasuries, very, very low. Some of the safest places you can put money. It will create what we call a little bit of noise in your life because you got to constantly check which banks are paying 3.5 versus 3. So it might cause a little noise in your life moving some money around. The reason I like whole life as my primary foundational asset is that it's got a return that I have not been able to beat in the last 10, 13 years straight. And every year my policies get more efficient. So, from a yield perspective, it's really hard to beat insurance. There's also no risk because it is a very safe, secure asset. And there's no noise because once the policy is enforced, you get a contract that everything stays in force for the rest of your life. And so this is part of the reason why it makes it such a tough, compelling asset. Now, let me show you a policy that I've owned for over 10 years. I got to hear an orthodontist in Chandler, Arizona, speak about this many, many years ago. And after listening to him and seeing what he's doing and reading some books he recommended, I was like, I need to get one of these for myself. And so the first policy I ever bought almost 13 years ago, I'm still saving $8,000 a year in premium or savings. Now, there's a lot of numbers on this screen. We do have these videos like this recorded if you want to like study the math in detail. But basically, in this 13th year, I'm gonna pay in $8,000 of premium or savings, and it's going to grow by $13,000 with no risk that very next year. Also, no taxes. So this policy will grow $1.63 for every dollar I put into it. Now, that's a heck of a place to be storing cash. I could use that growth and that cash to go invest. I could use it to take a vacation with my family. There's a lot of things that we could do with that. And I've got over $700,000 of protection on my life. I'm going to pass away at some point. I just don't know when. Now, let's go 15 years in the future. And the reason I'm going to use 15 years, let's go from year 13 to now year 28 in this policy. So 15 years from now, Kyle's going to be making money still. I'm going to need to store or save money somewhere. If I save it into this policy, if I save 8 grand into this policy, it'll grow by $24,000 that very next year, no taxes, or $3.10 for every dollar I put into it. And the reason I'm using 15 years is if you get on some of our systems and processes, you follow our tough money curriculum, you understand what wealth level you're in and what to do next, you will be shocked at how fast you can move in a money game. I believe every American can win the money game in 5, 10, or 15 years, but most of us have no idea what to do next. And so we're constantly trying new things, and it slows us down tremendously. And part of it is not having a solid foundation built. Now, if we go another 15 years, year 43 on this policy, so I'd be in my 60s at this time. The minimum premium on this policy is 2,600 bucks. So I've been pretty much putting in $8,000 a year into that policy, but I can do in as little as 2,600 bucks. So if I have a bad year in my business, I could scale the policy down and pay around $200 a month, 250, right? Somewhere in that range is my minimum. If I pay the minimum premium in the 43rd year, it'll grow by $36,000 with a $2,600 injection, no taxes. And I'll tell you, I'm paying more in taxes now than I was at 25 years old because I'm making a lot more money today than I was as a 25-year-old kid. So that policy, because there's no taxation, that is a very effective place for me to save. It'll grow $13.50 for every dollar I put into this. Now, check this out. Here's another policy from a client I work with. And this guy bought insurance the same time I did. The difference was the premiums he was paying were $90,000 a year, not $8,000 a year. So this guy bought one of these policies the same time I did from a really good company, but his insurance agent did not know how to help him use his policy as a wealth building tool. So a lot of people have life insurance, but they don't know how to use life insurance as a wealth building tool. Now, check this out. His premiums are like 11 times my size. $90,000 of premium he's paying, that's called savings. But his policy this next year, the same year that mine is, will grow $154,000 that year, no taxation. So it grows $1.72 for every dollar he puts into it. It's almost identical to mine. If this guy goes another 15 years and he's getting better at making money every single year, if he pays $90,000 in premium in year 28 of this thing, it's going to grow by $307,000, no taxes, no risk. Doesn't matter what the stock market's doing, or it grows $3.41 for every dollar he put into this. And this guy, when I showed him how to use some of his policies, he actually bought another policy that's like 4 times this size. Because once you see this, you're kind of like, well, how do I get more of my income through this if this is what's going to happen in the next 5, 10, 15 years? And if you've read that book, Becoming Your Own Banker by Nelson Nash, you'll get some of that context and that idea. There we go. Andres has it right there on the screen. I love it. So let's look at now. Let's take one of these policies now that we kind of understand how they grow in the future, and now let's look at how you might use this to now start investing, right? So we know life insurance is not an investment, but you can use it to make some investments. So let me go over a couple different options, and this is one that everyone has been doing, which is you save up money in some type of commercial bank, and they're going to give you, a couple benefits. Let's say you've accumulated $50,000 in savings at your local bank. Well, then you find an opportunity. Maybe it's a piece of real estate. Maybe it's the stock market. Maybe you're buying a business. Who knows? You have an opportunity to invest in something. So what do? You drain your savings account down to zero. You move it from your savings category to the investing category in the attempt to create new money. So the whole purpose of investing is you give up control of your money and then you put it into something else that's going to produce money back to you if you're good at investing. And then what do we do with that cash flow or the money from the investment? It goes into some bank account, it accumulates, and then we deplete that account and move it back over into an investment. And you're constantly interrupting any growth potential in your hold category. So, how do we eliminate that? Well, we have to use a different option. Now we're going to go to option two, which is to use a whole life policy and a commercial bank account. So I still use a commercial bank. I just don't keep a lot of my long-term savings there. So I'm going to take some money that's in a bank account and I'm going to move it into an insurance contract. Why? It offers me a lot more benefits. I'm going to cover some of the benefits in just a minute. But one of the benefits I get is it's a much more aggressive place for growth. I don't have a bank that I can put in a couple dollars and it spits out $1.62 for every dollar going into it, especially with no taxes. Now, if I'm saving up in this whole life insurance contract, let's go back in time. So I'm 37 today. When I was 30, I was having lunch with a real estate investor here in Mesa who's 70 years old. He's a good mentor of mine. And I was telling him, I said, Steve, I'm waiting to buy real estate because I think the prices are going to come down. I think the market's going to crash. And the reason I was thinking that is because I lived through 2008 and my parents got obliterated financially in the 2008 real estate crisis. So I was kind of watching the market like this feels kind of like how it did in 2008. And that was my limited education and understanding of real estate investing. And so he sat me down at lunch and he said, oh, I don't want to burst your bubble, but this is very different than 2008. In fact, home prices are going to skyrocket because we have so many people moving into our state during COVID. And so after he showed me the data, I went home to my wife and I said, Diane, we need to buy a home like today. And so we got on the search. We ended up finding this single family home for $335,000. We needed $17,000 for the down payment. This was a primary residence. So rather than taking cash out of a bank and giving up the interest I could have earned on that 17,000, I had an insurance policy that I had been saving into for a number of years. That same one I just showed a previous slides ago. So instead of using my own cash and interrupting the compounding of that, what I do is I call up the insurance company and I say, hey, I've got $60,000 of cash value in this policy. I would like to borrow from your account to leave my full 60 in there earning interest. I would like to borrow $17,000 from your general account. Now, the insurance company will not ask you what this is for, what are you buying, what's the repayment schedule. It's one of the most flexible ways that you can use and borrow money. So the insurance company loans me 17 grand. They're going to charge me 5% to use their money. But I have $60,000 earning like 4% every single year. So I never lose control of my money. And I go buy this house. So that money gets deposited into a checking account. I go use it to buy the down payment on this home. And then 2.5 years later, we sold that home and made a $200,000 profit. This was one of those events that if I could go back, I would have bought in 5 more of these homes. But I was a little bit nervous to buy my first piece of real estate. And so that's what I was comfortable doing. But that real estate investor was absolutely right. He said it's not going down. In fact, it's going up dramatically. So I took that 200,000, we paid down the line of credit on my policy, and the additional cash flow, instead of keeping it in a bank doing nothing, is going to go back into several policies that I own at this time, and I keep that money permanently in my family's wealth control. Now, if you want to take a picture of this, you can. We do have this on a video, but here's kind of how the math would break down. So if I were to do option one on the left, here's the impact it had on Kyle Fuller's wealth plan. In 2020, I buy this single family home for $335,000. The down payment needed was 17 grand. I had it in a checking account at Chase Bank earning 0.01%. So it was earning nothing for me. If I take the 17,000 out of that checking account and give it to the mortgage company to buy my house, I give up what $17,000 would have earned me if I could have earned about 4% on it for 60 years, age 90. So if the $17,000 didn't cost me 17 grand, it would have cost me $179,000 towards my wealth plan. That's that interest cost that we were talking about earlier in the call. So what did I do? Option two, I took $17,000, I put it into an insurance policy first. So now I own it and I control it and I earn interest for life. Then I take a policy loan against it. So my cash is still in there earning interest. I use the insurance company's money to buy that piece of real estate. I did pay around $2,000 in interest to use the insurance company's money. So I want to make sure that like we're super fair with this. But that 17 grand that is still in an insurance contract earning interest for me every day will earn me about $179,000 by age 90. Now, here's where it gets fun. That was a pretty good investment we made because 2.5 years later in 2023, the home price skyrocketed to $550,000. And in the Phoenix area, it was nuts. People were waiving inspections. They were getting $50,000 over asking prices because they were moving out of California and Washington and Colorado. They were all coming here during COVID. And it drove the demand up so aggressively. I told my wife, I said, Diane, I know we love this home, but this is one of those events. We need to sell this and get everything out of it that we can. So luckily we did. We made $200,000 net profit on that one deal. Now, if I would have taken the 200,000 and just said that was a great investment we made, let's put it into a safe, secure account like a US Treasury, which has earned about 2.6% net over the last 60 years. Assuming it stays the same, I would have taken that $200,000 investment and I would have earned $935,000 by age 90. So not a bad thing created with $17,000 buying a piece of property, right? But what I did instead is I said, hey, I'm going to take this $200,000 net profit. I'm going to put it into my insurance policies that are earning closer to 4% long term, which will earn me about $2.1 million over my lifetime. Now, to put in $17,000 and earn 200 is like a 500% return over just a couple years. That's one of those events. So if I could go back in time, COVID was an event that put a lot of businesses down. COVID turned into an event that actually made my family quite a bit of money. It was an opportunity to become wealthy, but we were prepared for it. My only regret is I didn't listen to that mentor of mine, and I should have bought in 5 homes, and we should have put hundreds of thousands of dollars down on properties and then sold them 2.5 years later. We might have put $1 million in our pocket in a 2.5 year time frame. And here's the encouraging part, though. These events happen every 5 to 7 to 10 years. They come around, but if we're never prepared for them, it doesn't matter. We never get to capitalize on the opportunity. So I've been studying these banks for a long time now. And what frustrates me is these banks will offer us products like CDs, checking accounts, high yield savings accounts. But these big banks that we're all aware of, these numbers at the bottom, 24 billion, 19 billion, 12 billion, these numbers represent the cash value in their insurance contracts that they own. They are actually the largest buyers of whole life insurance in the entire United States. And so if we want to become our own banker, we got to think more like bankers and we need to start positioning some of our money where they position theirs. So Bank of America does not save with Chase Bank and Chase Bank does not save with Wells Fargo. They put their long-term cash savings into very specially designed insurance contracts. And the reason they do is because they get a ton more benefit from insurance companies than what they're getting from the commercial banks. So the benefits we receive from a commercial bank would be like it's very safe, it's liquid and accessible. So you need access to your money and it's safe. And sometimes the banks, depending on the market, will pay you a higher interest rate to keep your money there, maybe 3, 4, 5%. But that money is still going to be taxed. The reason they love insurance, the reason I love insurance, the reason I would say whole life insurance is the toughest asset is because I have not found a liquid, safe asset with this many benefits built into one place. So when you buy one of these contracts, you get a guarantee that your money will be constantly compounding, is always liquid, it is very private. You have a death benefit, which is an income tax-free transfer of wealth. You get a competitive yield for your entire life. Your cash values are growing every single month, regardless of what the market's doing. And you have that flexible loan provision that I just talked about how I used this to buy real estate. You will not find this many benefits in one place. I have checked, I have looked. The banks know this. It's why they're the largest buyers of this stuff. So, part of the reason why I believe Americans don't save enough money and they don't hold cash reserves, because where we're keeping cash reserves is so inefficient. Why would we ever save money if it's never doing anything for us? So I want to end with just a few real life examples. So who's buying this stuff and why? So I want to give you a few different options of just things to get your wheels turning. So this 6-year-old at the top, this is an adult client we work with that saves around 250 bucks a month for their kid. And when this little boy right here, I know who this is, when he was 30 days old, his parents bought an insurance policy on him. Why? To help with future financial needs. These kiddos we're raising, they're going to need stuff. Bikes, braces, sports, cars. They're going to need things in their life. These parents decided they want to save money with whole life, so they get those 8 benefits. But this little guy has $23,000 of cash value accumulated in that policy. That policy grows $131 every single month, net of any taxes. There's no bank account I've found that you could provide for a child that also grows this fast, but also has $685,000 of permanent coverage. And one of the things that we hear most often with our educational classes is, I wish I would have learned this stuff 20 years ago. And we have a lot of adult clients that put these policies on their kids because their kids have so much time to compound. So let me skip down to this 35-year-old. This is actually me. This was a couple years ago. So that policy I showed earlier, the $8,000 in premium, this is that same policy. So I had 87,000 in it like 2 years ago, and it grows $480 a month net of taxes. That's more than a lot of people's real estate is cash flowing, and there's no risk, there's no noise, there's no tenants, and it's got just under $700,000 of protection on my life. This is one of the most efficient, if not the most efficient savings environment I have found in the last 10 years. And it only gets better every single year, which is really cool. Here's a few more. This is a 66-year-old up here at the top. This lady came to us and said, I don't really care about the cash value, the loan provision. I'm not going to use this to invest in real estate or anything like that. But she came to us and she said, I want to save $10,000 a year in premium because I want $300,000 of death benefit. And so this gal owns some land in a rural part of Mesa that you can't buy raw land in anymore. It's all developed. And so her dad passed away and he owned a couple acres right next door to her lot. And when he passed away, he owed estate taxes. And her and her two siblings did not have enough cash on hand to pay the estate tax. So they had to sell his acres just to pay the estate tax. And she owns a couple acres that's been in their family for 90 years. So her thing was, when I pass away, I need cash that's going to go to my kids so that they could pay for any type of event that I'm not thinking of right now. And so she's using the policy for like an estate planning purpose, but she's got 73 grand in there and it grows $535 every single month in net of taxes. Like, she loves that. No bank's going to pay her that, especially not with those additional benefits. This 36-year-old in the middle, this is an investor in Texas we work with, a big real estate investor. This guy had like 100 grand sitting. And he's like, I want to put in $100,000 up front, and then I want to pay like $25,000 a year. That's comfortable for me. But the minimum I want to contribute is like 10 grand. So if I have a bad year, I can go down to 10. If he has good years, he's going to keep putting in 25,000. So he built up $187,000 of cash value quite quickly in that policy, and he uses it to buy real estate. And the reason he likes it is that policy grows $1,200 a month net of taxes. So he's like, I can be way more patient looking for better deals because his cash position is so efficient. And this guy down here is a business owner I've been working with. And and he puts in about $250,000 minimum. Typically does like 600 to 700,000 in premium. This is a really successful business owner, and he's got $2.2 million of cash value, and his policies are growing $17,000 a month net of any taxes. And so there's just no commercial bank that's willing to pay all of that. And the cool part is that big business owner and that 6-year-old are all getting these 8 benefits every day for the rest of their life. So they are maximizing the benefits they deserve. And the frustrating part is banks could offer us more benefits if they wanted, but they just choose not to, which is why we gotta let's go give our money to institutions that actually care and have family values and are willing to give us more bang for our buck. So if we go back to our original path of money framework, money is going to flow into our life. We can do 4 things. We can spend it, we can donate it, we can save it, and then hold it is the third thing, with the fourth thing being invest it. Now, hopefully, now we've learned there's more efficient places to save and hold dollars that'll give you a lot more benefit, that'll make your investing career more advantageous. It'll keep you tougher during financial events. And if you're struggling with unpredictable income, excessive spending, reliance on credit, lack of liquidity, or retirement uncertainty, getting one of these policies will help you solve all of those problems at the same time. It's easier to save money when you watch your policies grow every year. You'll actually be excited to save. The bigger your policies get, the less reliance on bank credit that you need. You build up enough of your own banking system, you don't have to ask permission to use money to start your own business or to invest in real estate or do whatever you want to do. And what's cool about these policies, we didn't talk about it tonight, but you can, at a certain point, let's say you're 65 and you want to retire. If you've been paying into a policy for 20, 30 years, you can use that policy and start spending everything that you paid into it and use it as a retirement distribution asset, which is really cool. So we are going to teach another class this month. We do a deep dive topic every month, and we're going to be going really deep on the benefits of whole life insurance. So we'll make sure everyone that registered tonight gets an invite to that class as well. All right, that's going to wrap up our idea number 3. So the 3 ideas we talked about to build tough money. Idea number 1, how do my habits affect my wealth plan? That's the question that we wanted to answer. Idea number 2, which is the problem. How does the world of banking affect my wealth plan? And then idea number 3, the toughest asset. What is the foundation of my wealth plan? I don't think there's a tougher foundational asset than whole life insurance. So, what are the next steps? It's really simple. Get with whoever invited you to our educational class tonight and book a free session with our team. Identify your next best steps with a path of money analysis, and you will know exactly what to do next in the financial game. So I appreciate everyone tuning in tonight. I know we're right at 6 o'clock on the money. I'll stick around for a few minutes. You're welcome, Monty. Thank you for tuning in. If anyone has any questions, you can unmute yourself. You can put them in the chat. I'd love to answer any questions before we hop off tonight.
I just want to say thank you, Kyle, for your time and your expertise.
Oh, it's my pleasure. I loved connecting with you earlier, or that was last week. So we'll come down there to Tucson and we'll do some of these classes and go much deeper on these topics too.
Sounds great. I'll be waiting on you.
All right. Thanks, Andres. All right. If there's no other questions, we can all go spend a little bit of family time. We appreciate everyone tuning in tonight. Have a wonderful evening, and we'll see everyone in a few weeks on the deep dive topic, which is going to be going deeper on those 8 benefits of life insurance. You're welcome, Josh. Thank you, everyone. We'll see everyone next month.